All right, we are back with another episode of the Real Estate Investing Club. It is a beautifully sunny day here in Seattle, Washington, something we don't often have. So I am super excited to be talking to Tom Higgins today from Terra Capital. He is a master in multifamily, 2,000 multifamily units throughout the U.S. He has quite a breadth of experience on the multifamily side. So I am super excited to jump into it. Tom, thank you very much for hopping on the show.
Hi, Gabe. Thank you for having me today on the Real Estate Investing Club podcast. I've been listening to you for a while now, and I think you bring a lot of value to all levels of real estate investors. So I really appreciate that and enjoy your content.
Absolutely. Well, thank you. And yeah, we're excited to have you here. I told you before we got on here, we like stories. We like to hear how people got into real estate. You're a young guy with a lot of success already, so I'm sure you got a good story. So why don't we jump back to the beginning? How'd you get started in real estate?
Sure. So we were talking about this earlier, but born and raised in New York City. Both my parents were in real estate brokerage. So I grew up in a real estate household. Around the dinner table, we were always talking real estate investing, sales, strategy, what's going on. So it's really been a lifelong passion for me.
Nice.
I came at it from a little bit of a different angle than my parents, though. When I was very young, my parents were talking about selling properties and selling units and selling houses. I was always a little bit more curious on how you actually build buildings, like what really goes into it, what is the whole picture. And I have this memory of when I was very young, I was in a yellow cab going up Madison Avenue with my mom, looking outside the window and seeing the old pre-war buildings and just being like, how did people build these back then and now? Right. So I think from a very early age, I would say even high school, I kind of set out to be able to do that, get the skills, get the knowledge, get the access to be able to build buildings. And so after high school, I went to Columbia University. I studied economics. I got my brokerage license as just a kind of a foot into the industry. I took every finance class I could. I took every real estate focused class I could. I leveraged that experience to get internships in the summer in real estate investing, as close to the development world as I could get. And then I leveraged all that to get an internship out of college at one of the largest private developers in New York City and just worked my way up the totem pole. And, now I can say I've managed projects that are on the New York City skyline. So it was a successful road. It was a bumpy road, but I learned an enormous amount. And now I can, with confidence, say I know how to build a building, and you definitely can't do it alone. So after leaving the private side and doing ground up and adaptive reuse in New York City, I wanted to get a more national view, kind of continue my growth. So I worked for one of the largest home builders in the United States called Lennar Corporation. Oh, yeah. And I did, so I did institutional grade ground up development for them in New York, New Jersey, Connecticut, and Pennsylvania. And now I run Terra Capital, my company, and my business partner, friend from Columbia University. We started Terra. Now I run Terra Capital's real estate development operations and construction management teams.
Nice, man. That is awesome. And it sounds like you have all of the background that you need to be successful in real estate. People come on here so often and they say they had parents who were investors, who are developers, who are agents. And I'm always jealous of you guys because, sitting around the table, and I'm sure when you were younger, just kind of hearing it through osmosis was a big benefit going into it.
Definitely.
And it's cool. I mean, it's cool you had the kind of the development bend, the side of real estate where you're actually creating the product. Investing, it's so much business, financial oriented, and oftentimes we look past the fact that it's structures that we're dealing with. And so when you get back to it and you get to the development side, I'm sure you have a better view on investing and what it takes to run a good product.
Well, ironically, now I actually don't do any ground up.
Mm,
And I think, the reason for that is it's the ground up development is very cyclical. It's very timing based. The
yeah.
market needs to be in this correct rhythm between construction costs, rental prices, and interest rates. And, we're really not there.
Yeah.
And I kind of, when I formed Terra Capital and my business partner, we saw the writing on the wall, and we didn't want to go out and raise money and bring in partners and investing partners to do something that we didn't believe it was the right time to do it. So we took a zoomed out approach and kind of created a unique and modern investing strategy. And what Terra does now is we buy mini multis. We're trying to get this term coined, but really it's 2 to 15 units, value add multifamily properties in high growth, recession resistance Midwestern markets, specifically Columbus, Indianapolis, and Pittsburgh. And so we buy these properties majority off market, and we roll them into portfolios of about 150 units. And we use that to get returns to scale, and then also portfolio arbitrage on exit when we sell the portfolios to end buyers and investors. So it's taking these little properties, building large portfolios, fully optimizing them, fully renovating them, making them all turnkey, and then selling that as one asset that's cross collateralized across the whole market. It's almost like an ETF for multifamily within a city. So you're like buying a Pittsburgh portfolio, you're buying a Columbus portfolio.
Right.
So you're de-risked by having all these properties across the whole portfolio. Maybe one property gets reassessed and your taxes get increased, but now you have another 40 properties that haven't been reassessed and you're still doing very well.
Yeah.
It's one example.
Yep. Yeah, that makes a lot of sense. And focusing in on one specific city, I'm sure there's economies of scale there. You're using the same construction team, the same management team, all that stuff. So it sounds like you guys got a good model. I'm very curious why you chose, you say mini multis, small multifamilies. Why did you cap it at 15? That's kind of, I mean, I don't know if
Yeah,
it's arbitrary, or is there
no, it's
something about
not.
that number?
It's not arbitrary. 15 is really just kind of what we've seen. So before we ever raise a fund and go and invest in a market, we do it with our own money first, proof of concept. And so we're really active in the markets, and the markets that we're in, the majority and really our sweet spot is 8 units.
Mm,
And that's really the multifamily, these Victorian style properties kind of start to limit out around 8, 9, 10, 11, 12 units. And then if you kind of jumped it, a lot of people say, like, why not 40 units, right? From our standpoint, a 40 unit deal starts inviting syndicators
yeah.
into the deal flow. And I would argue that it gets as low as 20 units. People may be like,
Oops, it looks like we're having
so when you have those,
sorry, you cut out just a second there. So just continue on where you were.
sure. So I'll just go back to what I was talking about. So, in these markets, you have syndicators or small family offices or high net worth people that would be willing to raise money to buy a 40 unit, to buy a 30 unit, to buy maybe a 20 unit. And so there's more buy pressure. We focus on really what I view as the void in the market, and it's what we call properties that are too big for flippers and too small for syndicators or developers. And that's really that 8 unit deal. And we get the highest, and I don't know what metric you like to use, yield on cost, cap rate. We get the highest stabilized cap rates in that space. And as you kind of pass by that 15 unit mark, that I've noticed that those cap rates start to go down.
Yep.
And like I said earlier, like, we like to be across the whole market. And if we're doing a 150 unit portfolio and we buy one 30 unit building, it's overweighted to that neighborhood and that street and that location.
Yep, that makes complete sense. So let's kind of use a case study here. I'm going to take Indianapolis because we just bought a self-storage facility out there. I know it's a great city. So when you went into Indy, kind of what was well, first, why did you choose Indianapolis specifically? And then once you did choose it, how did you start rolling it out and acquiring properties in that market?
So why we chose Columbus, Pittsburgh, and Indy, and I'll focus on Indy in particular, is that we like to target markets, and I'm really hyper focused on this, and we'll talk about this later in the episode as well, but I'm really focused on healthy markets. And for what that means to me is that markets that have affordable rents for the people that live there. We want the average we say people make $100 a year, right? We only want them to be spending between $15 and $25 a year on rent. And that allows for like just a healthy, happy renter base that can afford to pay. The constituents in the city are happy. They can use the amenities in their neighborhoods that they're in. And we like to kind of merge with the fabric of these neighborhoods. So that's the first criteria for us, is that we want to pick healthy markets. As much as a lot of investors like to talk about supply constraints and it being a phenomenal opportunity because there's so much population growth and so much demand, like I've been through that and it sounds great and it may be a quick pop, but the reality is that and I'm sure you're the same way, we're investing in these markets long term. We're building great networks. We're knowing everyone in the market. We're heavily investing in it, both politically, but also from a capital standpoint. So I don't want to have to pull up shop in 5 years because it's an unhealthy market now.
Yeah,
So,
like Phoenix. Up and
there's,
down.
I don't want to go through the list and upset some of your viewers, but there's a lot of them, right?
Yeah.
So, we're hyper focused on healthy markets, but within healthy markets, you need resilient job growth to basically really believe in that long term. So we look for markets that are over indexed in bio or healthcare industries as well as education. Indy in particular is more in the biomedical space and pharmaceuticals, whereas Columbus and Pittsburgh are more specifically in hospitals and healthcare. But that's the sector that we're targeting, as well as education. We also like to see, with the reshoring that's happening across America right now, we like to see centrally located areas that have good logistics. So we like the concept that new companies may be attracted to move into Columbus, move into Indy, move into Pittsburgh because of how well they're located. And this is why the cities did so well when the US was a manufacturing-based economy and not a consumer-based economy. But as we try to bring reshoring back, we're starting to get a lot of the benefits from that. And, we get asked sometimes like, Tom, how did you know that Intel was coming to Columbus with the largest tech manufacturing facility? They announced it in 2022. You've been investing there for longer than that. It's like, we're not trying to predict specific industry growth. We just like to have, and we go on and on about this, but we like to have layers of beneficial things that attract business, attract tenants, attract residents, and all of it works well together as a holistic picture. And we're not chasing the news. We're not chasing pops and interest because Intel or because, robotics, because, tech growth, if that makes sense.
Yeah. Yeah. And it is dangerous to chase those, unique one-off benefits that a city may experience, because those things can disappear overnight. And so you really, that model makes a lot more sense to me, looking for metros that have, layers upon layers of benefits and reasons for people to be living there. So you chose Indy, Columbus, Pittsburgh, because they were great metros. They were healthy. So once you chose them, how did you go about? First you need to find deals, and then you need to build a team on the ground. You're in New York, you're outside of the actual metros themselves. So let's tackle those two questions. It all starts with deals. So let's start there. How did you first find your first deals when you got into these metros?
Yeah, so like I mentioned earlier, we always go in with our own capital first before we bring the fund. And we did our first fund in Pittsburgh, our second's Columbus, Indy, and Columbus, Indy, and Pittsburgh as well. But before we break into a market, we do a proof of concept deal. And what that looks like is that we buy a mini multi in the city. Typically, our first deal will be an on-market deal before our off-market engine's really rolling in that city. But what we've experienced is that you pay a little bit more for on-market deals. So if the deal in the system works with an on-market deal, it's definitely going to be working with off-market deals. So we'll typically break in and get a foothold and then use that again on our own dime to vet contractors, vet service members, vet our team members kind of there. And we'll limp through that first experience. And then if that's still successful, then we'll bring our capital, we'll bring our investors along with us. And then we have a very well-oiled machine at this point that I believe we buy between 70 and 80% of our deals off market at this point. I actually pulled the numbers this morning for you. We send 1,500 mailers a week. We send 1,200 emails, and we do over 1,000 cold calls every week.
Wow. That's interesting that you do emails. I did at one point. I didn't see a lot of success with it, and so I just kind of took it out of my off market
Put it back
marketing.
in. Put it back
You're
in.
seeing some good
Oh
success,
yeah.
huh?
You know
Interesting.
what it is that everyone has a different medium that they feel comfortable with and that they like. And what we've learned, we've been doing this for a while now, like that email 2.5 years later, after you sent them 2 mailers, you cold called them twice, it's like finally they'll respond.
Hmm.
Right. So it's always an interesting, what do they say on average? It's 7 touch points before someone talks to you.
Yeah.
I don't know if that's data is right, but I do sense that, at longer you're in a market, bigger your off market pipeline will become. And what we've seen a lot of experience with, because again, we have a pretty buttoned up institutional approach to buying mini multis, is that we get repeat sellers. So, we're buying in this uninstitutionalized space. 0% of mini multis are owned by institutional buyers or institutional companies, right?
Yeah.
A handful are owned by maybe new funds like us. But the reality is it's all slightly older people that may have inherited or just picked them up on their way. And they very often don't own one. They very often own 2 or 3 or maybe 4, right, in the market. They'll be, okay, we'll sell one to you. And then, okay, a year later, they liked getting that cash. And again, we're doing heavy value add. So these are not renovated properties. They may not want to put them on the market. There's a bit of a self-respect and ego thing that's tied up on there, where the person knows that they could get more value for their property if they renovated it, so they don't bring it on the market. But we approach them off market and they say, hey, we'll take it from you. And we don't buy anything that's owner occupied. It's kind of a rule of our fund. We like to deal with investments rather than people's homes.
Yeah. And doing mini multis, I think that is, I mean, that's the reason I started in single, and it's the reason I left single family, is because I didn't want to deal with homeowners. But if you're in mini multifamilies, those are mostly, I mean, predominantly investors. So I feel like you're still in that sweet zone where you're talking more business to
Yes,
the seller versus taking their home from them.
exactly right. Yeah, it's just not our style. We like
Yeah.
to deal with investments.
Yep. All right. Well, I took a peek at the clock. We are running the clock down. I do want to ask one more time. You've kind of touched on it, but once you get into these markets, how do you build out your team?
Yeah, so we use a multiple different approaches, but the one that I've actually had the most success with, well, we've had success with a few, but the one that I find kind of interesting and maybe not what everyone's doing to build a team is that we run very well tailored ZipRecruiter ads in
Oh,
every
interesting.
city that we get into, kind
Okay.
of even before we start investing in that city. And that allows us to really set up a lot of interviews, talk to a lot of people, and really kind of vet through and hire and fire until we build a phenomenal team. We have a lot of requirements for our interviews, and we have a lot of requirements for our construction partners and how we ramp them on and how we keep them accountable. Again, my background was in institutional construction management, so I was able to take a lot of the best practices from there and bring it down to the mini multi space and kind of create good guardrails for people, good systems, good checks and balances. So we like to really start with, again, smaller deals. Like say if we buy an 8-unit mini multi in our market that we're going into on our own money, we would give one of each of those units to a different contractor to start to vet out and feel out how they work. Maybe we'll give 1 to 2 of them, etc. But we like to start them small and grow them. And we have a
Yep.
rating system for contractors, and each contractor, level 0, level 1, level 2, level 3, and each of those has a maximum amount of units they can be renovating at each time. We love to see level 0s become level 1s, and we help them grow. We give them tools to make them better. Sometimes we'll grow a level 1 to a level 2, and then they'll stop working with us. But it's still nice to be able to kind of give people consistent work and give them good guardrails to grow their construction business.
Yep.
So that's what we focus on.
Absolutely. And yeah, finding good contractors is it's one of the most difficult things and can be most frustrating things about real estate because there are so many contractors out there. But once you find that good one, you got to hold on to them because they are worth their weight in
Yeah.
gold for sure.
Yeah, I agree, but you can never get complacent, right? You can't just say, okay, I have this great guy, my problem's done. You always got to be interviewing. You always got to be growing your foundation, especially at the speed and the amount of deals that we're doing. You know, I've made the mistake early on when I was just doing syndication of kind of being like, oh, I have my great contractor. Then,
It's done.
true story, he died,
Ooh,
right?
yeah.
So like I was like, what am I going to do? You know what I mean? So now I learned my lesson and it stopped the job for months. And it was a problem getting someone to take a job over after it's halfway through, et cetera, et cetera. But we were able to rally and make it work. But my point is that I think it's so important for any real estate investor that has a value add component to be always growing that foundation and always growing that base and do it through a system and try to remove emotion from it. But that's just my opinion.
No, that's wise words, and it's another reason why networking and going out there, who are meeting other contractors, meeting other agents, other brokers, is always important in your real estate business because you can never have too many good people, and you never know when one might pass away or move on. So,
Yeah,
sounds like
exactly.
you guys are having some great success, and I hope that continues for you. We have run down the clock, so I'm going to push us into the quick question round. Are you ready?
I'm ready for it.
Let's do it. Starts with books or education. Give me two recommendations, one for general life wisdom and then one for real estate specific.
So I'm going to add them both together and say Principles by Ray Dalio.
Oh, I
Uh,
like it.
it is, a phenomenal book for figuring out how to set up your own principles to invest, setting up the principles of the company you want to build, setting up the principles of your life. They are all connected, and I think they all need to be very, very rigorously vetted every year, every quarter, however you're able to do it. But it's been phenomenally beneficial for me to think about my investing, my funds investing, my own company with his framework. And I think he did a really amazing job in that
Yeah,
book.
that is a great book. I actually just picked up his second book, and it was a funny story. My For Christmas, I bought the new book. What was it called? It's the coming or the shoot, I don't remember the title. His new book. I bought it for my dad, and then on Christmas Day, when he opened his present, he had actually bought the same thing for me.
Oh, I
So we
love
bought the
that.
same book for each other.
I love
But
that.
yeah, Principles, that is a great book. Definitely worth picking up. Moving to the next question. This is for your younger self. So let's go back to the Tom who was just getting his first job out of college in the development world. Go back to him, look him in the eye, give him one piece of advice moving forward.
I think, and I've been thinking about this a lot lately. I think the most important thing for me then and now is real estate is a service business and it is about individual people. And often, as you build an 800 unit building, you build a 150 unit building, you have a portfolio with 50 buildings in a city. Sometimes the numbers can start to not feel like humans anymore, and it's really, really important to not lose touch of that. And if you're kind of emotionally connected to the people that are keeping you in business, I think it really helps the frame of making decisions, helps with, in a COVID type environment, making deals with individual residents, kind of all the way down the value chain. I found it very, very helpful for me to have a more human approach to it.
Nice. Yep, that is a great. It's great advice and difficult when you're working at scale. So I love it. That moves us to the next question, and this is about your business. Like you just said, every business is run on the people that run it, and the first few people who jump onto your team, those are the most crucial. Let's not talk about the actual people, but about the positions. So, what are the first three positions you hired for, and would you do it differently if you started again today?
Yeah, so we right now have had a very kind of unique approach to hiring, and I think um, Well, there's history to this, but Trammell Crow is a very famous old development company, and they were the kind of the initial people that broke the industry into all these different sections. They broke it into property management, they broke it into asset management, construction management, all these things. They fractured it, right, to kind of create a system. And now everyone today is like, are you a property manager? Are you a blah, 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 blah. But prior to that, real estate investing was an individual or a group of individuals doing all of it. So we kind of wanted to pull it back to that original framework. And it was always something that really attracted me when I was coming out of Columbia. It was like, I want to work at a vertically integrated company and I want to touch all of it. So how we hire is we hire young, smart men and women from great colleges that want to know how to asset manage, want to do property management, want to source deals, want to rent deals, want to sell deals. So we hire real estate professionals and we teach them the whole business. And then we give them the tools and the resources to execute that in these phenomenal markets that we invest in.
Okay. So, I mean, I totally agree that it is good to have breadth of knowledge, but each person has to have something that they uniquely do, correct? Or else, you
No,
can't.
so we create a vertical, right, where each individual oversees every part of the deal cycle, from sourcing the deal to finally selling the deal. They're involved with every single step of the process. And there's
Oh, okay.
ultimate ownership. And there is no like, oh, he didn't rent it well, or he
Yeah,
didn't
yeah, yeah.
renovate it well. There's ownership from the day of acquisition to the day of exit.
And so you guys are doing it by project, not by role, by
Well,
property
the
rather.
role would be a real estate investment analyst, and then associate, et cetera, and it
Mm-hmm.
would kind of climb up that ladder. But yeah, it's an individual that is hired to work for us as a real estate investor that does the whole process, the whole development curve from start to finish. And we don't break or fracture our team into property management, asset management, and construction management.
Very cool. I love it. All right, moving on. You've already given us the answer for this one, but I'm going to ask it anyways. The United States is a big place. There's a lot of opportunity out there, a lot of square miles. So what is the single metro that you are most excited about investing in today?
I personally love Pittsburgh, Pennsylvania. Um, there are a lot of phenomenal markets out there. I think that Pittsburgh, for me, just the fabric of the city, the way the geography works, the opportunities that there are in my buy box, really, sing a great picture. But obviously, all markets that have good job growth and healthy foundations, I think are where people should be laser focused on. And like, I know people love to talk about Georgia and talk about these other states. It's like, that's fine. And I'm sure there's great opportunities, but maybe take a step back and like try to think 10 years down the line, 15 years down the line. So
Nice. Yeah, I've heard good things about Pittsburgh. Never been out there myself, but heard it's pretty out there. And that moves us to the next question. This is about finding deals. There's a lot of ways to do it. What is your favorite way?
well, because we chatted about it already, I'll say emails has been the most interesting one for us. I'm always shocked, like you are, when a deal comes through via email. But we have acquired in the last 3 months 2 deals via email, so it's real.
That's
It's
it's
real.
worth it, and it's also the cheapest way to
Yeah, yeah, yeah.
market. So there really
200 emails a day, 6 days a week. That's what we do.
yeah, yeah, there really is no reason to do it. I don't know why I stopped. Well, I do know why, because I wasn't getting a lot of traction, but I'm glad that you guys are having success, and that is definitely a good way to go about it. Moves us to the next question, and this is about mentors. None of us are islands. We all stand on the shoulders of giants. So who is one mentor who has contributed significantly to your career today?
Well, he's probably going to blush, but my business partner Ray, he is a mentor of mine. We are peers, but there are certain traits that he has, kind of his ability to be like, I'm maybe excitable, or I maybe can get caught up in the deals, but he's phenomenal at staying true to the company's principles. Go back to Ray Dalio. And so for me, kind of watching how he systemizes and how he stays consistent and focused for all our deal approvals and lets deals go that don't pencil, even though I'm like, oh, maybe we can add value, maybe we can add value. He's very, very strong at staying completely committed to our principles, and it's been phenomenally successful for us because there is always another deal. So in a way, his ability to do that is something that I've consistently learned from and try to strive to.
Nice. Yeah, it sounds like you guys balance each other out well. So shout out to Ray. Thanks for helping Tom get to where he is today. That moves us to the second to last question. This is about your Superman strength. We are all gifted with strengths that we uniquely provide this world. So what is your Superman strength?
I would have to say it's resilience. And for many, many reasons that we don't have the time to get into today, but that's something that has always kind of resonated with me from a very young age, is this concept of resilience. Be there for others, be there for yourself, and keep going. And we were chatting about jujitsu earlier, and 6 years into jujitsu, I can tell you resilience is very, very, very important to my mental state and that part of my journey as well.
Yep. Yeah, it's important for anything you do really in life, is the ability to just keep going, get yourself up when you get knocked down. So resilience is a great trait to have. That brings us to the very last question. This is for the listeners. You've given us a lot of good things to think about. I'm sure people want to reach out, get in contact with you. What can they expect when they reach out to you, and where's the best place for them to go and find your contact information?
Well, let's keep it easy and just say usaterra.com. I'm active on LinkedIn, Twitter, and very active on Bigger Pockets. So feel free to connect, and all that can be, figured out from the website.
Cool.
We are actively bringing on new investment accredited investors and investment partners for our second fund. So would love to chat with anyone that wants to learn more about our opportunities.
Perfect. That is USA Terra with 2Rs.com. I will put that link in the show notes. So if y'all want to reach out to Tom and learn a little bit more about what they're doing over there, go ahead and click a little more in the description. It'll pull down the full description, and in there you can find Tom's URL.
Awesome.
All right, man. That wraps it up. Thank you very much for hopping on the show.
Thank you. I really appreciate it. It was great.
Absolutely. For everybody who's here with us today, thank you guys for showing up. You are the reason we do this. If you guys have any questions whatsoever, reach out to me, Gabe at therealestateinvestingclub.com. And if you guys want to support the show, all we ask is you give us a thumbs up, like, share, all that jazz. Other than that, I hope you guys have a great week. Keep rocking real estate. And I look forward to seeing you on the next episode.